Hello, I'm Brian Daingerfield. I co-head G10 FX Strategy at NatWest, based in the US. And today I'm going to talk about implications from the Trump presidency as we consider actions taken and not taken in his first week in office. Trump has gotten off to a very fast start. He's actually signed over 100 executive orders. But from a market perspective, none are more important than what he did and did not do on trade policy. We know that in the build up to the election and also during the transition period, Trump has been very active in trade threats. Specifically, among other things, he's threatened a 60% tariff on 100% of Chinese imports, an additional 10% tariff on all Chinese imports as relates to border policy, and additionally, 25% tariffs on all Canadian and Mexican imports into the US. There have also been threats of universal minimum tariffs of as much as 20 to 25% on global economies as a revenue raising measure to pay for additional tax cuts. So Trump has threatened a lot in the transition period and before the inauguration, and some of those threats were even imposed for day one. But now that day one is behind us, what we have seen is that Trump did not follow through on these initial threats, at least in the immediate term. What Trump instead did is he issued an executive order on trade policy, which opened up a lot of doors to use trade policy aggressively and unpredictably, even though he didn't follow through with any particular tariff threat just yet. Specifically, Trump has a lot of authority given to him by Congress already on trade policy. This includes an alphabet soup of potential options that Congress has given the president. Some are more methodical and take longer. Others can be taken very, very quickly in the name of national security or in a national emergency. Trump's executive order that he issued on Inauguration Day essentially leaves all of those options open. Trump asked relevant authorities within the government to consider some of the more methodical approaches over the next couple of months. But he also kept the door open to moving more aggressively. And outside of an executive order, he did suggest that on February 1st, he could consider moving forward with those tariffs. As we think about trade policy, the market's initial reaction has been one of maybe cautious relief, if you will, that Trump did not go through with the most aggressive trade pushes immediately when taking office. But additionally, we do think that the makeup of Trump's cabinet suggests that Trump might lean into unpredictability as part of his trade strategy even more than he did in his first term. We do think that it's interesting that the former architect of the trade war, Robert Lighthizer, who was the USTR in Trump's first term, was not invited back to join the cabinet in a second term. Instead, you have relatively less experienced names, ones who are not government, sort of career bureaucrats running commerce, for example, but then also USTR, is a relatively junior voice compared to Robert Lighthizer. We do think that the decisions made at the top in terms of trade advisors suggest that Trump maybe wants to centralize trade policy to himself and maybe use a bit of that unpredictability as part of his strategy. So while markets have taken his initial push as less draconian, sort of less extreme, and have really rejoiced in that, there are still these risks, none more pertinent than this immediate deadline that Trump himself has set on February 1st as a potential timing when we could get more details on Trump's initial trade push. Additionally, markets are also watching Treasury, and the Treasury Secretary Nominee, Scott Bessent, is generally considered a market-friendly choice. And he's going to have a very important role, not just in trade policy, but also in taxes. As far as tax policy is concerned, Trump won't be able to move as quickly on taxes because it will take time to actually write the tax law. And of course, unlike on trade policy, he will have to work his policies through the Congress. Now, Republicans do have majorities in the House and Senate, but they don't have a filibuster-proof majority in the Senate. And what that means is that Trump will have to the Republicans will have to rely on the archaic budget reconciliation process to get their priorities over the finish line in 2025. That introduces natural potential delays in getting bills done. But what we will be watching in the next couple of days is when do we get details on the nuts and bolts of reconciliation? Because one of the debates on Capitol Hill right now is, should Republicans start with border security bill first and then transition to taxes? Or should they do, as Trump likes to call it, one beautiful bill where everything on his legislative agenda is combined into one big package? If they split the bills in two and move on border first, that could naturally delay the timing for when a tax cut bill could get over the finish line. We do think it's reasonable to expect a tax bill coming around the middle of this year. But as I mentioned, the sequencing and the issues around reconciliation do present some risks to that timeline. It's roughly consistent with what we saw in 2017, where it was about a 6-month lead time between when the tax bill really started in earnest and when it was ultimately signed at the end of 2017. There's no specific deadline that they have to work to other than the end of 2025, which is when some of the expiring provisions of the original Trump tax cuts start to roll off. But in terms of a soft deadline to consider for tax cuts, one we can look for is the debt ceiling, the hypothetical X date at which point the US could consider a technical default. Congress loves working to self-impose deadlines, and the potential for a technical default is something that could prove an attractive deadline of sorts for congressmen to work to in order to get a tax bill over the finish line. Now, that's a moving target in terms of when Treasury would ultimately run out of funds and potentially experience a technical default. But if that date were to come around the summer, that could be a deadline to which Congress tries to work towards, pairing an increase in the debt ceiling with a tax bill. And so we do think, for a number of reasons, the middle of next year is a reasonable assumption for when a tax bill could get done. Turning back to markets, Trump's tax policy and trade policy are two critical pieces of how Trump impacts the outlook for the US dollar, US interest rate markets, and equity markets as well. Specifically, in the build up to the inauguration, we've seen significant moves in US interest rates and the dollar, both higher, to reflect expectations of Trump policies, including, among other things, tariff-related risks to inflation here in the US, and also the possibility of pro-cyclical fiscal stimulus coming this year, in combination perhaps supporting US growth and weakening growth expectations abroad. That combination has led the dollar to rally heading into the inauguration period, and also US interest rates have generally risen as the markets have reduced expectations for the timing of Federal Reserve interest rate cuts. The Fed in December effectively announced that they're likely to be pausing interest rate cuts for now, and we think that pause continues through the next couple of months here, reflecting this more cautious stance. What is also true is that during the transition period before Trump took office, we have seen US economic data, generally speaking, surprise on the upside, particularly on the activity and labor market side. And so not only have you seen the dollar strengthen in higher interest rates as a reflection of policies expected by the Trump administration, but also from the reality on the ground that the US growth story continues to be one of the most attractive in the world. And as a result, the Federal Reserve is believed to be more likely to be cautious in further interest rate cuts relative to its peers. What we will be watching from here is trying to figure out what's priced in for Trump. It's very difficult to assess what is now already in the price, given the moves we have had, the substantial moves in some cases in the dollar and interest rate markets. Trade's a really good example of this, because if Trump were to go more aggressive on trade in these early days, that could mean further extension of these moves, further extension of this risk of downside risk to growth for our global peers that are more exposed to tariffs relative to the US dollar, for example. But if Trump were to continue to take maybe a more relaxed or slower methodical approach, that could mean that too much Trump trade war risk is priced in. So we will be watching as we consider Trump the reaction in markets. I think the two things we'll be watching most closely are getting a sense of how much of Trump is effectively in the price already, if we need to extend that pricing or maybe pull back a bit, and also the performance of the US economy. Sort of, I call it in the background almost, that the US economy has shown this penchant for outperformance. Its outperformance has been not just against its global peers, but well above what most market participants have believed for quite a while now. And so I think those are the things that we'll be watching here as we consider Trump's agenda in his first 100 days. Thank you very much for listening.